Have you ever wondered what it's really like to think like a venture capitalist? Well, today, that's exactly what we're going to do. We are going to break down a real live startup, Harmony Nutrition, that's raising money from the public right now. This is a deep dive into an actual crowdfunding case study.
Welcome back to another episode of Invest Guru. Let's jump into a young company using crowdfunding. We're going to look at their pitch, the deal they're putting on the table, and most importantly, the really tough questions you should be asking before you even think about investing a single dollar.
So equity crowdfunding is amazing, right? It lets pretty much anyone invest in a startup, sometimes for as little as $100. But here's the catch. How do you sift through all the hype to find a potential gem? How do you avoid the high-risk gambles? Well, that's our mission today.
All right, first things first. What problem is this company even trying to solve? For any startup, the size and, frankly, the urgency of the problem is everything. So let's see what Harmony is all about. It all starts with this number, and honestly, it's pretty staggering. 1 out of every 5 babies has real trouble with standard infant formula. We're talking inflammation, digestive issues, the whole deal. This is not some tiny niche problem. It's a huge, medically driven issue in an already massive market.
And this is where that statistic gets real, For these parents, feeding their baby turns into this source of daily anxiety. They're stuck with these hypoallergenic formulas that can smell terrible, taste bitter, and are often packed with things like corn syrup. A lot of babies just reject them. It's a nightmare. So Harmony's pitch is to completely flip the script. Instead of just trying to modify cow's milk by stripping things out, they're building a formula from the ground up, using human milk as the blueprint. That means using lactose, which is the natural sugar in human milk, instead of corn syrup. They're not just trying to avoid a negative, they're trying to replicate a positive biological function for immunity and gut health.
Okay, the story is compelling. I get it. But, and this is a big but, a good story does not automatically make a good investment. So let's take off our parent hat, put on our investor hat, and really deconstruct the deal that's on the table.
All right, just so we're all on the same page here, we're talking about equity crowdfunding. This isn't a donation, you're not pre-ordering a cool gadget, you are buying a piece of the company, or, in this case, the right to own a piece in the future. That means you get to share in the potential upside, but you also share in the very, very real risk that it could all go to zero.
In early-stage investing, you are betting on the jockey, not just the horse, and Harmony's team looks like a real strength. The CEO, he's a repeat founder who's already built a nutrition company and launched over 30 products. And look at the advisors. You've got industry vets from the exact companies they'll be competing against, plus clinical experts from top-tier institutions. That is a huge advantage.
Now, the product itself, it's got some serious science behind it. This isn't just a new recipe they cooked up. They've gone through more than 55 prototypes to get here. And critically, they've filed 4 patents to protect their approach. That intellectual property, that's their moat. It's what could stop a giant competitor from just copying them overnight. And the numbers? Well, the market is just massive. But here's what really stands out to me. Professional venture capitalists, the smart money, have already put in $13.5 million. That is a massive signal of validation. You combine that with a projected customer lifetime value of $2,400, and the financial picture starts to look pretty interesting. Okay, let's get into the nitty-gritty of how you actually invest. Harmony is using something called a SAFE. Now, this is super important. You are not buying stock today. You are signing an agreement that gives you the right to get stock in the future, usually when the company raises a bigger, professionally priced round of funding. So here are the actual terms of that SAFE. The number you really want to focus on is the valuation cap. The first investors get in at a $26 million cap. So what does that mean? It means your investment will convert into shares as if the company was only valued at $26 million, even if the next funding round values it way, way higher. That cap is your reward for taking this early risk.
So far, it sounds pretty good, right? But hold on. No investment is without risk. And a pre-revenue startup? That's about as risky as it gets. So now we have to do the most important job of any investor. We have to weigh the bull case against the bear case.
So on the one hand, the bull case. You've got this incredible, world-class team with a proven founder. Awesome. But the bear case is just as real. The company has made $0 in revenue. It's all a projection. Their first product for toddlers doesn't even launch until 2026, and the big prize, infant formula, is years away. That is a long time to wait with a lot that can go wrong.
Okay, now what about the market? The bull case is obvious.
a $100 billion industry with a huge unmet need. Great. The bear case is equally obvious. This market is an absolute battlefield, dominated by giants like Nestle. If Harmony starts to succeed, what stops these behemoths from just crushing them with a copycat product, or just buying them out?
And finally, the product and the price. Bulls are going to point to the patents and that big VC investment. But the bears will come right back and say, hey, infant formula is one of the most heavily regulated products on Earth. Any regulatory delay could be catastrophic, and that $26 million valuation cap, still pretty steep for a company that hasn't sold a thing. Your entire return depends on a massive future exit.
Okay, deep breath. We have gone way into the weeds on this one company. But how do you take this kind of thinking and apply it to any other deal you might see out there? Let's zoom out and build a little framework you can use. Here it is, a simple 5-point checklist for your own research. Number 1, the team. Do they actually have the experience to pull this off? 2, the product. Is it a real must-have or just a nice-to-have? And can they defend it? 3, the market. Is it big enough to matter and is now the right time? 4, the deal. Do you actually understand the terms you're signing? And 5, and this is the most critical question of all, can you truly afford to lose every single penny you invest? Because with startups, that is always a real possibility.
And that leaves us with one final question to chew on, and it really gets to the heart of Harmony's gamble. What's scarier for a startup? Is it trying to invent a market that doesn't exist yet, where you have no competition? Or is it jumping headfirst into a massive, proven market, knowing you've got to go to war with giants? There's no easy answer, and that right there is what makes this stuff so challenging and so fascinating.